52,490, 52,500 actually is where the Nifty Bank is at. Mid-cap index is flat, and I think you've got a small-cap index will come up on your screen, which is also largely flattish, nothing, almost unchanged at this point. Nifty heat map gives you a quick snapshot view. What do we have? It is more down than up, certainly. Banks are on the sort of top end in terms of what's doing well. On the other side, it's basically a plethora of things. It's a very, very mixed start. Surabhi.
Okay, by the way, there's some breaking news coming in on CNBC.com that China has replaced its top trade negotiator to try and circumvent this absolute roadblock of a negotiation with the US. So keeping an eye out on all the global developments as well. But for the time being, let's look at what's taking the market lower here. Maruti is down about 1.5%. It's the weakest stock on the Nifty right now. Tech is weak. Infosys is down. HCL Tech Mahindra, Wipro, which is reporting numbers. All of the tech stocks are lower. Zomato, which is now known as Eternal, the listed entity, 1% lower on that stock as well. Reliance is not helping the bulls' cause today, also putting pressure on the downside. Global-facing stocks, basically global-facing stuff is weak today. Tata Steel, Hindalco, IT, like I said, all of these stocks are on the lower side. Now, what's the counterbalance? It's financials, as we've been pointing out. HDFC Bank, 0.6% higher. Kotak Mahindra Bank, Axis, 0.5%, 0.25%, these kind of gains. I mean, the banks are not charging away, but they're at least preventing a wider fall. ICICI Bank itself is also trying to hold on to a gain of about 0.25%. So basically, it's a bit of a risk-off sort of a market. There's some buying on lever as well. Asian Paints, ITC, very close to the flat line. So basically, risk-off, going back to a little bit of the conservative side of the market. That's what's going on. And Eicher Motors, by the way, is the top winner on the Nifty for the time being.
Well, IRDA as well is higher in today's trading session. That's spiked up in trade. Yesterday had a good close to trade. There'll be a Gensol hit that will come, but that'll be in the following quarter, I think. So for the time being, the street has read those numbers positively. EPAC Durables, that's another stock that's opened high with a gain of close to around 4% or thereabouts. A good move. JPM Auto, that stock is flying away. It's up close to around 6.5%. So big up move is what we're seeing on that particular name. And on the flip side, you have Goldium. That's cooling off a little bit. Remember, the last few trading sessions, that stock has seen a big run. So we have Goldium that's cooled off a little bit in today's trade itself. Keep an eye out on some of these textile companies because the Bangladesh has banned import of yarn from India through all land ports. So I think Vardhaman Textiles is one stock that could get a bit of a hit out there. For the time being, I think the stock Vardhaman Textiles, let's get that stock up for you. Nitin Spinners as well as another one that could get hit a little bit, a mild hit out there, just down 1% or thereabouts. So stocks not really reacting to that piece of news for now. But the Nifty Bank, that's the one that's leading the way in today's trading session, up close to around 150 points or thereabouts. The big winner from the F&O stocks, ICICI Prudential, up 3.5%. So that's the big winner. And on the flip side, you have MGL, that's the biggest loser because of the APM gas cut. They'll have to source their gas at a higher price. That's why Mahanagar gas is down a good 5%.
And IGL as well. IGL is down about, MGL of course much larger cut. IGL is down about 1.5% as well. What else? I mean, Infees, the biggest volume-led loser, it's down about 1% right now. There's Mazgaon, which was a big winner yesterday, is down about 1%. Small moves. ICICI Lombard is a bigger one, which is down about 3.5%, 4%. As I said, we'll have the management up with us at 9:50. Zomato, Eternal is down about 1.25% or so. Maruti is down 1.6, 11,660 on Maruti. Amber, Sun Pharma, Sai Life was a big, I think, 10-15% mover yesterday. That is coming off a little bit, 3.5% right now. These are just reversals. I mean, Home First was up, I think, about 6% yesterday. It is down 2.5-3% now. Kaveri Seed was a 5-6% mover yesterday on the upside. It's down 3% right now. So this is just sort of a bit of a flip-flop after the very large gains that we saw on many of these names coming through today. Apart from that, I mean, not very much. We've mentioned, I think, bulk of what is happening and bulk of what is moving out there. Well, let's welcome in Manishi Ray Chaudhary, Chief Executive Officer, Emer Capital Partners. Manishi, good to have you here. Thanks very much, as always, for your time. You know, as Manish Chokani said, and I think it's a general feeling, right? Just look at the price action here. The market wants to go up. You can feel it. But there aren't enough triggers, I guess. And of course, I mean, there's a problem of valuations and single-digit earnings growth, etc. as well. But what's your sense, Manishi? Markets, I mean, I'm talking about India here. over the next few months?
What you said almost hits the nail on the head. It's the situation right now is that valuations are, they have no doubt declined over the last 6 to 7 months, but not really as cheap as investors would like them to be. And at the same time, the bigger concern is that earnings growth, earnings estimates are still declining. In fact, there was a small uptick to the consensus EPS estimates for both year 25 and year 26. But when the present earnings season, the result declaration season started from the first week of April, the earnings estimates have started declining again. And I think that for India, rather than the global noise that we are seeing, is possibly a bigger concern. And and that's why I said just about a couple of weeks ago that I think Indian investors would have to wait. They have to brace for another leg down during this earnings season. At the same time, if one looks at the long term, India is clearly better placed than many of the Asian peers. After all, a 10% tariff is better than 26% of tariff. And at the same time, as a consequence of this global reshaping of the supply chains, that's kind of inevitable now. We will almost certainly see more of what Apple has been trying to do. So it is over the long term, not so dismal a picture, but in the near term, we have to brace for more valuation correction and more earnings estimate decline.
Okay, so earnings will continue to be a reality check. Got that point. Manishi, just give us 1 second. I wanted to look at two stocks, JBM Auto and Electra Green Tech. Nice surge on both of these, 4.5% to about 7% on JBM right now. Electra is up about 4.5%. There's some buzz about a large order, electric bus order, could be as big as 10,000 crores. And of course, these companies manufacture e-buses. They're part of the supply chain. So perhaps there's some excitement on who gets the win, if they get it, if Tata Motors gets it. So worth putting that out. But Manishi, to get back to the point that you're making, that earnings continues to be maybe our Achilles heel. But isn't the fact that the fourth quarter is also sort of, it's going to be maybe muted, maybe not as bad as Q3, isn't that already in the price? And what are the numbers that you have in mind? I mean, how will we end Q4? The projections for next year talk about maybe, 10 to 11% earnings growth. Do you think that will actually happen?
10 to 11% for next year, which is fiscal 26, is kind of reasonable. But many of the earnings growth estimates that I'm seeing from consensus, if you look at Bloomberg or FactSet, they're actually in the mid-teens even now. They're in the 15, 16, 17% range. And I think those estimates will have to come down. Which are the sectors that would suffer? I think, consumers, particularly consumer staples, these companies are constantly, in each and every quarter, they're postponing their turnaround target. I hear analysts asking the companies, when do you think your earnings environment would bottom out and demand would, gradually begin to come back? And almost in each and every quarter over the last 2 or 3 quarters, I'm seeing that it's going to happen in the next 2 quarters. And that timeline keeps on shifting. So that would be clearly one sector where I would expect earnings estimates to come down further. Second, IT services. Even though services sector has not been hit by the Trump tariffs, there is a clear wait and watch environment among the U.S. corporate investments. So, investors or rather the corporates are not really willing to invest more in either capacity expansion or improving productivity through tech investments. And that's not good news for IT service companies. As these results come out, as we get more and more commentaries from the IT companies, I would almost certainly see another leg down in their EPS estimates. I would think that even some of the domestic sectors like industrials, consumer discretionaries, you would have earnings estimate downgrades, partly because those earnings estimates have not been downgraded to the full extent that they deserve. But honestly, I think the domestic sectors are possibly close to the end of their earnings estimate downgrade cycle. Now we have to be more careful about the globally linked sectors like IT, like metals, like some of the pharmaceutical companies and so on.
Just to recap that, Manishi, so you're saying downgrades in IT and in consumer discretionary, those are the big ones.
Right.
Where else will you see, or are you expecting big downgrades?
I would expect some of the other globally linked sectors also, let's say metals or other materials. So these 3 or 4 sectors put together is almost about 40% of the total Indian earnings, the earnings profile. So that is, those are the sectors that I would be more concerned with.
And do you feel that this reality of lower earnings, do you feel that it's not adequately reflected in stock prices in the market level right now? So there's a downside risk to the market. Is that what you're saying?
Yep. In fact, as I said, that if you look at the consensus estimates for the market as a whole, for most of the aggregators, it is turning out to be about 15 to 16% for both fiscal 26 and fiscal 27. I would expect at least the fiscal 26 number to come down to just low teens or early double digits.
Okay, all right, Manishi, appreciate you joining, and thanks a lot for giving us your view on the markets. We look forward to having a longer chat with you in the next couple of weeks. Well, time to get to an exclusive chat now. We are now joined by Mr. Sandeep Pondrik, the Secretary, Ministry of Steel, who joins us on the show. Hi, sir. Good morning, and thanks a lot for speaking to us here on CNBC-TV18. And before I move forward, I just wanted to compliment you as well as your team. You all were rallying for some kind of protection for the steel industry, and very rightly so, going by the kind of uncertainty we have in the global backdrop. And this is the second time I've seen in the last 10 years or so that you'll have come in there and helped the steel industry. I recall the MIP that was imposed in 2015, and now, in fact, the safeguard duty as well. So good going on that front. But, sir, we have a couple of questions on that front. When does the safeguard duty of around 12% take shape? When does it get implemented? Point number one. Point number two is there are various rumors and murmurs that maybe, in fact, that safeguard duty could move up to around 20%, purely going by the kind of uncertainty, kind of dumping we're seeing from the Chinese. Is there a possibility for it to move up?
So, thank you and good morning. On the first question of safeguard duty, when it is going to be implemented, as you know, DGTR has given its recommendations. They are in public domain. DGTR has recommended 12% safeguard duty on certain products and with caps on prices of those products. That recommendation is under examination in the government. I think in very near future a final decision will be taken on that. I really can't give you a exact timeline, but my expectation is in near future a decision will be taken on that, so we can expect that. On your second question, point about 20%, I really don't know, because it's a, as you know, the DGTR process, the safeguard duty imposition process, is a sort of a quasi-judicial process, and DGTR has heard everyone, asked for objections, and after that they have recommended this safeguard duty. So I think when the decision will be taken, DGTR's recommendation will be the main basis on which the decision will be taken. I don't see any reason for the rumors about 20% safeguard duty.
Okay, all right. Thanks for clarifying that, sir. But near future, could you quantify it? Should we work with 45 days to 2 months? Would that be a fair estimate? Within this time, we should see the implementation?
You know that I really can't give you exact timeline, because it's not the Ministry of Steel which will take a final decision. It's the Ministry of Finance in consultation with Ministry of Steel and Ministry of Commerce and everything. So I really can't give you a exact timeline for that.
Okay, all right. But at least you're clarifying that as of now, we should be working with that 12% mark itself. You know, those rumors of around 20% for the time being, that they don't have any merit. What about steel consumption, sir? You know, that's been quite strong in India.
Yeah.
The globe has been in a tizzy, but steel consumption here in India has been good. 9 to 10% in an environment that was rather brittle. For this year, what kind of a number you're working with in terms of steel consumption growth?
So I totally agree with you on that. In fact, India is the only country, only major economy where steel consumption is growing in double-digit numbers. If you actually see the data, in 2020-21, we were 95 million tons, increased to 105 with 21-22, 22-23, roughly 120, 23-24, 136, and this year it is 151. So we are growing for last 5-6 years at least for in double-digit numbers, while the world steel consumption is roughly 1% or even less than that. In all the major economies, the steel consumption is either stagnating or going down. So India is the bright spot in terms of steel consumption, and we expect that this will continue, especially in view of the fact that number one, government spending on infrastructure is sustained. Government is pushing infrastructure. So more than 1 lakh crore last year, more than that this year on infrastructure. Then other government programs on roads, bridges, housing.
Yes.
Add to that the private sector development in real estate and other fields. So we expect that for next few years we will continue to grow in double-digit numbers. That's what our assessment is. And to match to that, we will need to have the production capacity.
Sure.
I would also like to point out one more thing which I have stated earlier, that the per capita consumption in the country now is more than 100 kgs per person. And it has been seen with respect to other countries that when a country goes at this level of 100 kgs per capita consumption, then the elasticity with respect to GDP growth rate increases. So till now it is 1.2, 1.4. Now I expect that the elasticity will be more than 1.5. So even if with that, if you see our GDP growth rate around 6.5 or so, then the steel consumption should grow about 10%.
Okay, so above 10% growth in domestic steel consumption. Got that point, sir. But sir, just to revisit what you said earlier on the safeguard duties, and you were telling Nigel that you don't see much merit or any reason behind these rumors of expecting 20% safeguard duty. If I could just press on that point a little bit, when the safeguard duty calculations happened and the industry had made its case with the government, this was the US liberalization day era, where anyway companies were talking about dumping happening from China and allied countries like Vietnam, etc. In this new reality where there is a tit-for-tat fight between China and the US and tariffs are as high as 145% on China, will 12% safeguard duty be enough to offer protection to the Indian industry? Because there's a huge fear of additional dumping through some other routes, circumvention, maybe not directly from China. Will 12% be enough, sir?
So let me say what has been the import in last year. If you actually see the import data for 24-25 as compared to 23-24, the import has increased by roughly 1 million ton. So it was roughly, I would say 8.3 in 23-24. This year it has been 9.5, so 1.2 million ton increase, which is about 14% increase. And most of that increase has, bulk of the increase is from Japan, not from China. So if we actually see the import data, China, Korea, etc. are more or less at the same level at 23, 24. I don't expect any major import increase because of the present scenario. Also in view of the fact that in addition to safeguard duty, we are also trying to see that misuse of licenses doesn't take place. We have got complaints that in certain cases and in certain countries, licenses are being misused by importers and exporters both. So that is under investigation, and we would try to put a stop to that kind of practices. So it's safeguard duty, I don't think is the only way to protect the domestic industry.
Mr.
Other ways of ensuring that the proper procedures are,
Yeah, sorry, I completely take your point. Good morning, Prashant here. In what way, sir, are these licenses being misused that you are sort of looking at?
So basically,
just to illustrate an example, with an example,
they are still under investigation. So just to get an example, basically what we are getting complaints is that if a particular license is with a licensee in a country, then multiple factories or multiple units are using that license to export steel to India. So suppose legally only one person to whom the license has been given to the entity, they can only export, but we have got complaints that malpractices in that respect is happening, that people are using that license to export to India. So similarly, the other example is where misclassification of products. We have got complaints that misclassification or wrong classification of products is being done to get out of the BIS and QCO requirements. So we have got those complaints. We are investigating them. We will try to plug those loopholes also, so that these kind of things don't happen.
Right. Mr. Pondrik, just to press on the earlier question, I think you made it clear, but allow us one more attempt. Not on the rate of 12 to 20%, but do you reckon, because I mean the US-China thing looks like a very, very protracted thing. Our imports were only about 3 million tons from China. But the point is, it could be, more steel could come from other locations. So are you worried about that? And also, will more products need to be covered under these kind of safeguard duties, stainless steel, etc.? Or you think that's not necessary?
For now, I will stick with what the DGTR recommendation is, and if we see in future that what you are seeing is taking place because of the present situation, if there are any changes, then government can always have a relook. So that option is always open, but for now, I don't see any reason to have a relook at that for the now. On the product side, stainless steel, I don't think there is any application filed by stainless steel industry. As you know that for safeguard duty, the industry has to file a application with DGTR. So if the industry files, then the process will be undertaken by the relevant authorities, and government will take a decision on that.
Mr. Pondrik, just to clarify, final on this tariff point, can you tell us if in the last couple of weeks you've received any fresh applications from industry to consider a duty even higher than 12%? Or can you confirm if the DGTR itself could be thinking of maybe revising its suggestion of 12% as of now?
I can't comment on behalf of the DGTR because that will have to be answered by DGTR. In the Steel Ministry, we have not received any such applications for increasing from 12 to 20%. DGTR, you will have to ask the DGTR whether they have received any such applications.
Okay, all right. When I speak to some of these steel producers, they said the higher the better. But as of now, you're saying you've not heard it. So maybe, in fact, that's not yet reached your ears. For the time being, we'll work with 12%. Let's get a couple of quick pointers out of the way, sir. There was talk of this mega merger, NMDC Steel, SAIL, as well as RINL. Is that on the cards or no?
RINL, as you know, that government has given a lot of money to RINL to keep it as an ongoing concern. So I don't see any possibility of immediate merger. That decision is not there in the government. Similarly for NSL, so for now, no such talks are, or no such thing is happening in the ministry for merger of these three.
Okay, all right. And no merger as of now between these three. Also, any plans to divest NMDC Steel? Has that moved forward?
As you know, that the 21 decision of cabinet that NSL will be divested still stands. However, not much progress has taken place on that front. That process is undertaken by Department of Divestment, as you know. So DPAM is the responsible department for that. As far as our information is, not much progress has happened because of various reasons, including local resistance and all of that.
Okay, got it. All right, very quickly, sir, before we let you go, what about IOL conversation with the Karnataka government? They wanted to push through that bill, which is going to be increasing royalties to a very, very large rate. There's been to and fro. I believe that it's not yet got the green signal. IOL conversation with them for a more rational rate out there, because otherwise it will make mining unviable for a lot of these miners.
I agree that if we increase the taxes or royalties or whatever on iron too much, then it will have an impact on the mining industry. Also, that cost of iron ore in the country is already not very low. So if we increase that, then it will have its consequent impact on the steel prices also. As far as the talk with Karnataka government is concerned, that is being led by the Mines Ministry, because they are the nodal ministry for all mines, and the bill which has been brought by the government. Mines Ministry is talking on behalf of Government of India,
right?
Both in the legal system as well as with the state government.
Got that. Thank you so much for providing all that clarity, Mr. Pondrik. Really appreciate your time here on CNBC TV18. And we look forward you're able to join us more frequently to touch upon the important sort of issues with regards to the sector. Thank you very much indeed. We'll take a quick commercial break here. Markets have recovered a little bit. We're up about 25 points from being down a little bit. We come back and we put the focus on the BFSI space. We'll get you expectations. Abhishek is standing by. With that, quarter se quarter tak. Back in 2.
Welcome back. It's time for our special offering Quarter Se Quarter Tak, where we bring you key expectations from the quarterly earnings. Abhishek is joining in with the expectations from the banking sector in Q4. Abhishek.
Well, to begin with, business momentum of banks have softened quarter on quarter in Q4 FY25 versus Q3 FY25. So take a look at the deposit growth. At the end of the fiscal, deposit growth was around 10.25% YOY and about 2.3% sequentially. Q3 FY25 deposit growth was around 2.6% quarter on quarter. Now, advances growth rate have softened to 11% YOY and about 2.3% quarter on quarter as of FY25. Loan growth, however, continues to remain higher than deposit growth rate. So this compares to a growth rate that you saw of 11.2% YOY and about 3.6% quarter on quarter in Q3 FY25. So business growth rate of lenders have softened at a time when interest rates on liability side is at the peak or of the businesses at the peak. Hence, we can now see the beginning of cyclical pressure on net interest margin of lenders. Now, analysts do estimate that the net interest income growth to be sluggish in this quarter, especially for PSU banks. Now, PSU banks have largely raised deposits as a higher cost, while their loan growth is lower than the industry levels, is what analysts estimate. Credit deposit ratio, as a resultant of higher loan growth than deposit growth, the industry has witnessed or seen a credit deposit ratio at an all-time high of 80.8%, which reflects a more aggressive lending stance from the lenders. Now, this augurs well for some of the lenders to maintain their net interest margin at healthy levels if they are able to curtail their slippages. Now, credit cost for this quarter, certain sectors, especially those with unsecured lending like microfinance, are expected to face higher credit costs in Q4 FY25. Slippages for the banks could be on the higher side quarter on quarter, which could lead to higher provisioning requirement and thereby impact the earning capability of the lenders. Now, with respect to asset quality, while asset quality is generally stable, concerns will remain around the unsecured lending portfolio of lenders, which are expected to witness continued deterioration like they did in the previous quarters. So, analysts do estimate higher slippages for the banking sector in Q4 FY25 versus Q3 FY25. With respect to earnings outlook, overall, the earnings are expected to remain weak, particularly for PSU banks, largely due to lower net interest income growth as well as lower treasury gains for some of the lenders. Higher credit costs can be seen for some of the lenders, thereby impacting their earnings momentum. Overall, earnings are expected to see weak momentum for the banking sector in Q4 FY25. Now, we do have some of the key estimates from Kotak Securities. For SDFC Bank, they are expecting NII growth to be about 8% YOY, while PAT growth to be about 5% on a YOY basis. For ICICI Bank, the NII growth is expected to be at 8% YOY, while the PAT growth also to be at 8% YOY. For Axis Bank, Kotak Securities estimates NII growth of just 4% YOY, while profits can decline 7% YOY. For SBI, they are estimating NII to decline by 2% YOY, while PAT can decline by as much as 43% YOY and more than 30% quarter on quarter. For Bank of Baroda, Kotak Securities estimates NII to decline by 3% YOY, while PAT to decline by 16% on a YOY basis. Back to you.
Okay, all right, Abhishek, thank you very much for that. So getting set for the Q4 financial earnings season. To talk about this, we've got Santanu Chakrabarti, India analyst at BFSI at BNP Paribas, joining in. Santanu, great to have you on. It's all eyes on financials. All hopes are now resting on big banks and NBFCs in the market, and we're seeing that in stock prices as well, right? The question is, will earnings match up? Your opening thoughts.
Right. I mean, it's very clear to us that this quarter marks the bottom on earnings growth for the sector, right? Maybe not the bottom for margins, which is one quarter further out, given the rate cuts and all of that, which we had expected. But earnings growth from here on out by the middle of the next financial year is supposed to reach from negative territory into mid-teens. And therefore, what the market will be more focused on is not the known fact about what the balance sheet growth looks like for each of the businesses, or the fact that, next quarter there'll be a margin hit. I think investors will focus a lot on what's happening on the growth outlook front. And this especially becomes salient in the context of the liquidity support that the RBI has been providing. And if RBI was to be backstopping all liquidity impact of foreign selling, then from that onwards, we would expect some acceleration in both loan growth and also commensurately deposit growth, because if money is not leaving the system by means of current or capital account, then every rupee of credit growth will translate into a rupee of deposit growth. So that's what the setup is, which is why I think the outlook provided by the banks and what could be perhaps the first set of constructive commentary on growth in a long time would be the key determinant this result season.
So to put that in some broad numbers, Shantanu, let's say if I decide or anyone decides to buy large cap banks as of now, and I'm talking not Q4, I'm saying FY26, what is the kind of growth in the book that one would be buying at current prices? And even margins, while I take your point that, the margin recovery could be some time away, look at what banks have done. HDFC Bank, ICICI Bank, they're already announcing a cut in deposit rates. It's happening really quickly, the transmission. So that perhaps is better than what the market would have hoped, because usually deposit rates are lowered with a lag and therefore you have that pressure. So give us a sense, next couple of quarters, anyone who's buying banks right now, what kind of growth and margin outlook are they buying into?
Right. I mean, Suri, extremely pertinent observation on your part. And I think the next leg of that trade is clearly current account and savings account starting to pick up. Especially, Survi, you hear this very often talked about that the reason that current account balances in the last 3 years have not really moved for banks is that because the government has got more efficient at managing its day-end balances and so on and so forth. Now, if you look at the gap which has opened up, that cannot be explained by that phenomenon alone. I think if you dig a little deeper, you'll see the main reason, that current account has lagged in India over the last 3 years, lagged the growth in money supply and deposits, is because, businesses in India, frankly, have gotten more conservative on their cash cycles, which is basically that the working capital cycles for businesses in a period where money markets have remained tight, in a period where credit policy from banks has been tight, have got extended. So the amount of, say, check values that clear on a daily basis have gone down, which essentially is the current account balance. Now, the good news around that is if businesses get more confident with, say, getting money from a CP at the end of the day, or if they call their bank for a OD extension, it's going to come through, then automatically their payment terms start to get, better. And that has a ripple effect through the system, and current account balances will move up again. So, what you're seeing in terms of rate cuts or HDFC making a statement by taking its, savings rates to 2.75, just 5 basis points north of SBI, all of that is just beginning of the easing cycle. And I completely agree with you, which is why we are very constructive on FY26 earnings growth for banks as a whole. The only headwind that we see is that from slightly low levels of credit costs that some banks have in this financial year, the next year you might see some normalization. But it won't dull the overall earnings picture.
Okay, Shantanu, just got 10 seconds left on the chat. Since you're very constructive on banks, give us the top picks.
Right. Topics are HDFC, ICICI and Axis in that order. Of these, ICICI stands out in a slightly different way in that if the rate cut cycle doesn't pan out, or the acceleration that we are talking about doesn't pan out, is the least impacted amongst the three.
Okay, all right. Shantanu, a good conversation. Thank you very much for joining us and sort of getting that perspective. All right, ICICI Lombard is the next company that we're focusing on. Net earned premium has risen by 20% year on year. Underwriting losses have declined. Combined ratio is looking a little better. Let's bring in Gopal Balachandran, Chief Financial Officer at the company, who's with us now to take some questions. Gopal, good morning. Prashant this side. So for FY25, gross premium grew 10%, net earned premium grew 17%. Can FY26 be a better year on both these fronts? And what is the growth that you're baking in on these two matrices for the coming year?
So good morning, Prashant, to you and all of your viewers. So let me just kind of put this in context. I think when we started FY25, what we had kind of talked about is from an ICICI Lombard standpoint, we expect to have an outperformance with respect to top line growth. And that is exactly what we have been able to end the year with. I think the industry grew at about 6.2%. And on a gross direct premium basis, ICICI Lombard has grown roughly 210 basis points ahead of the market. And pretty much on expected lines, I think even on the combined ratio front, as you rightly mentioned, I think the trajectory is something that we have been able to see an improvement getting delivered. And more importantly, the return on equity range that we had been talking about between that 16 to 18%, I think we have been able to kind of pretty much live up to the expectations. Now to your point on how do we see things playing out for FY26, I think across different segments, I think the road that's kind of laid down looks very, very promising. Whether you look at the infrastructure investments and logistics coming in on the commercial lines, pricing uptick again happening in that segment, health looking quite promising, continuing to look to exhibit a double-digit growth, and even motor, I think in terms of how do we see things playing out in the subsequent year, looks promising. So all in all, I think what we would kind of continue to pencil in is to outperform the industry in that range of, as we keep saying, between 200 to 200 basis points insofar as top line is concerned, and obviously a trajectory to see an improvement in combined.
Sorry, 100 to 200 over industry?
That is correct.
Okay. On combined ratio, Gopal, you managed to protect the 102.5 level. Will it get difficult to improve from here on? And could you specifically give us what are you looking at for 26?
So I think directionally, Prashant, obviously what we've been able to deliver is a consistent improvement in combined year on year. That's what we had kind of spoken about as well. And even in fact, at the beginning of the year, honestly, if you look at in our April 24 earnings call, we did kind of expect the market to be slightly more semblance insofar as combined ratios are concerned. But if you look at the 9-month numbers, the industry has actually seen an adverse development in the overall combined. In fact, it has kind of moved by about 100 basis points from 112% the previous year 9 months. So the key thing to watch out for is what direction does the market take? And in that context is how we will be kind of positioning our opportunities. But everything remaining the same, definitely we would want to see an improvement in the combined going ahead. And more importantly, as I said, the return on equity range that we want to continue to start exhibiting to the stakeholders will be within that 18 to 20%.
Gopal, I just want to focus on the motor segment a little bit because some of the broker notes this morning are pointing out how the growth in motor is maybe a little soft compared to what the expectations would have been. One, obviously, it's a straight function of sale of new vehicles, and those numbers have been a little weak. But also, I mean, what are your expectations from that business? And are you expecting an increase in the motor third-party rates anytime soon?
Yes, Surbhi, good morning to you. I think let me answer the second part first. I think third party is something where for a reasonable number of years, I think there has been in that sense not a price increase that we have seen. As an industry, I think we have made representations to the regulator who in consultation with the government kind of notifies the price change. Thus far, we haven't necessarily heard anything from them so far. But obviously, as I said, we have made the right representations. And in case if the final notifications comes through with a price change, that's augurs very, very positive both for the industry at large and specifically in the context of ICICI Lombard, it will be a great, great positive. But to your first point in terms of how we see the motor segment play through, again, let me just put this in context. If you look at the current year, I think the key that we kind of keep watching for is can we continue to outperform the market? If you look at it on a full year basis, the industry grew on motor roughly at about 8%. ICICI Lombard's growth was roughly at about 11.5%. So we were able to accrete market share. Your point is right. In some sense, there has been a bit of a slight slowdown insofar as new vehicle sales is concerned. But obviously, I think when you look at in terms of some of the actions that the government and the regulators have taken to kind of spur demand on ground seems to be quite promising. And therefore, to that extent, we do expect new vehicle sales to come back, at least when we look at FY26. But more importantly, for ICICI Lombard, one of the areas that we have actively focused on is to see how we can significantly improve our existing renewals of the book that we have already underwritten. So hence, quite promising and a lot more optimistic.
On motor third party, you're saying industry has made representations and you haven't heard anything as of now. what is the kind of price hike that industry is seeking in motor third party? And also if you could give us some sense of the loss ratios there, because if that third party price hike doesn't come through, it's going to weigh on profitability, isn't it?
Yeah, so let me just again put this in context. When I said that we expected at the beginning of the year semblance to come in the market, it was also in the context of motor as a line of business. And as I said, we have the numbers for the 9 months. So if you look at the industry combined ratios on motor, this of course includes both own damage and third party. There, the combined ratios have actually moved more adverse. It has moved from 118 to 123. So hence, therefore, is where we are all kind of coming from to say that it's been 3-4 years of, let's say, no price change in the context of third party. Any kind of a price increase coming through, I think we will be very, very positive at. What that number could be, I think we will leave it for the regulators and the government to kind of decide in terms of what they eventually give out. But the good news, the other aspect that we would be kind of very, very closely watching for, Surbhi, is next year, which is FY26, happens to be the year when the IRDAI defined threshold on expense of management, wherein companies are supposed to kind of meet the threshold of expense of management to be within 30%. ICICI Lombard has always been within 30. Many companies have been exceeding that threshold. So once, if we see some discipline coming through with respect to the expenses of management, that will be a lot more positive as well in terms of how demand could kind of spur insofar as the market is concerned.
You know, since you brought up that point, Gopal, I must point out that our colleague Yash, who obviously covers the insurance space, you know him well, he put out a story a couple of weeks back on this business of expenses of management, that maybe the regulator could consider individual specific caps on commissions in order to quote-unquote kind of discipline the industry, because the regulator seems to be feeling that lower commissions are not being passed on in the form of lower premiums to the customer. Just your thoughts on this, if you've heard anything, and what will this mean if there is a specific individual cap on commission, not the total expense?
Yeah, so I think, so again, Surbhi, again, just put this in context. I think the regulator has been very, very at it to make sure that as an industry, companies kind of toe the line insofar as the expense of management threshold is concerned, which is why they gave that 3-year glide path for players to kind of work towards. As I said, FY26 is the year when you would see those companies having the need to kind of come down within those. So that will be a key regulatory watch in terms of how companies exhibit that trajectory.
Gopal, the point is, overall cap is fine, but there are commissions and there are operating expenses. Problem is, IRDA feels that commissions are through the roof. And that is, so is that a problem if it happens?
Yeah, so which is what I was kind of responding to, as in to say that I think one of the things that the regulator will be closely watching for is this threshold in terms of how companies are navigating. So long as they are able to see the direction of change in terms of companies going down in their overall cost of distribution, of which a very large proportion of which will also be the acquisition cost that they kind of exhibit to distributors, and that will be a key positive. So hence companies will have to actively work to make sure that they bring down their overall cost of distribution, that specifically in the context of commissions, at least in the context of ICICI Lombard, which is what I was talking about. I think we are very, very clear that insofar as the overall expense of management is concerned, we will be well within the norms. And two,
have you
and individual commissions, cost of acquisition of new business, where are you at right now?
So again, let me just put that in context. Even when the regulator kind of introduced these guidelines on long-term policies, which came into effect from October 1, clearly the intent from a regulatory standpoint was to try and see if we can get the cost of acquisition amortized over the contract period. From an ICICI Lombard standpoint, clearly we have stuck to it to make sure that at least insofar as the cost of acquisition for long-term products are concerned, it gets kind of remunerated over the contract period. So that's how we are focused on, and making sure that we kind of well operate within the laid down guidelines that the regulator has put in force.
Have you heard? The story was put out about a month ago. Have you heard from the regulator? Has there been any interaction on commissions in the last 1 month for the industry, not just you?
Yeah. As I said, the regulator is very closely watching this particular space, and I'm sure we will wait for any further actions on that.
Okay, all right. We'll leave it there then, Gopal. Thank you very much. Appreciate you joining us and running us through. The results, and of course that 18 to 20% ROE guidance, which I think is a bit of a bump up as compared to what they put out earlier. I mean, overall, directionally, things are looking positive. Stocks recovered quite a bit from the day's low. I think started about 3.5 lower. is down 0.8.
On the commissions, if I got him right, reading between the lines, I think the status quo is, Karo nahi to hum karenge. That's what the regulator is doing in this consultation and wait and watch period.
That is what Yash's story essentially was, that, it was a warning to health and general insurance against rising commission payouts. All right, well, let's just go back to the market for a little bit. Mitesh is back with us with a quick check on how he's looking at things. Looking much better, 35, about 40 points higher, 23,366. Mitesh, what does one do?
Yeah. So Prashant, we talked about buying any kind of declines. I think the gap down was immediately bought into with the Bank Nifty leading from the front. So I think that's where some trading opportunities can be identified. I have Bank of India as a buy recommendation. Keep a stop below levels of 112. Look for target of 118, 119. And the other one which I like is Nika. Gave a good breakout yesterday. Today is quiet, but the structure is positive. So buy here with a stop at about 181 for targets of 195.
Okay, all right. Thank you very much, Mitesh, for that. So those are some individual trades coming up. Commodities and gold very specifically in focus. Manisha joins us on the other side.
So 30 points up on the Nifty now with banks leading the charge. The Bank Nifty is soaring almost 1% higher. That's the shape of the equity market. Let's figure out what's happening with commodities. We have Manisha Gupta joining in with the latest. Manisha, what's capturing your imagination today?
Gold. I'm never not moving away from that. It is bulls in control when it comes to gold prices. And what a stupendous run-up that we've seen. Every single or every second day, you are looking at an all-time high coming into the markets there. So we're trading above $3,280 an ounce at this point in time, which is an all-time high. And with those kind of gains, we are up by 25% in this year after 28% of gains in all of last year. So it has been a one big strong rally that we are seeing in case of the gold prices right now. Well, also when you look at the overall markets, and this is an interesting chart that should come on your screens now. It tells you on how the gold prices have been moving on the higher side. I've taken the last 4 or 5 years here, and we're trading above 3,280 right now. If you look at the month of April last year, same time, it was at 2,350. So almost $1,000 of a jump up per ounce is what you're looking at in case of gold prices in last 12 months itself. April 2023, we were at 2019-20. So as you can see, 22 and 23, the gains weren't so much, or at an understandable range therein. But in last 4 years, we've come all the way from 1725 to 3275 right now. So very, very strong gains continuing in case of gold prices, with more and more banks and brokerages now upping their forecast for this year, for 2026. 27 and 28 as well. So banks believe that you could be looking at higher gold prices for the next 3 to 4 years as well. Various factors and which have been supporting the gold prices. One, of course, there's a lot of uncertainty around the US trade policy. And then it is a weak US dollar index, which is trading below 100. So no safe haven buying really coming in for the dollar index. Much of that money really seems to be flowing in case of gold. The falling US Treasury yields has been yet another factor there. And then the markets are looking at very strong inflows that we have in sense of investment in gold ETFs in India, in Asian markets, and most of the global markets therein as well. Also, you're looking at higher US debt numbers. The world debt numbers also have been growing. That has been supportive. And then the markets also are looking at the historical chart pattern data. If you look at the numbers from 2000 to 2025, it has been only 2 years that gold has given you a negative double-digit return. Apart from that, it has been positive cues continuing from gold, and that historical pattern also shows you that gold perhaps continues to be a favorite place to be in. For the Indian markets then, we are trading at above all-time highs, above 94,400. Interestingly, there are no buyers in the Indian markets. Most people tell us that the demand could have declined by 40% in the Q1 part there. And when you look at the markets right now as well, it is more about exchange and old gold coming into the market rather than sales of gold. And that has led to a big discount in the Indian markets. Well, I've been talking to some of the jewelers there, and they say $25 to $28 an ounce of a discount is what you are looking on bill. And in the cash markets, it's as high as $180 to $200 an ounce as well. Clearly, no buyers there. And a final plate should show you on what the banks and brokerages are expecting the gold prices to go from here. These are the only revised banks that I've taken in right now. So Deutsche Bank now says that they see a support at 3139, 3129 kind of levels, and their next target on the higher side is 3700. Goldman Sachs has talked about 3700 as well, with 4000 by the end of this year or middle of 2026. Bank of America and Citi have talked about levels between 3300 to 3500 as well. UBS has revised its forecast. This was a report yesterday at 3,500. De Beer has been saying 33 to 4,500 since the month of December now. And Swiss Asia Capital has talked about 3,500, 3,700 in this year. And the next 3 or 4 years, bullishness may just about continue. What the street, though, will focus in the day today is going to be the US Powell speech and the US retail sales data. That would make an impact on the dollar index and gold prices for the very, very near term, though.
All right, gold it is. Manisha, thank you very much for that. And we'll, of course, put the spotlight very much on this. So many angles to cover as far as gold and how well gold as a commodity has done. Well, we'll take a quick commercial break here. It's the economy on the other side. My colleague Lata speaks with Samir Goyal of Deutsche Bank to discuss global rates, rupee and dollar. Stay tuned. Interesting conversation up next.
Welcome to It's the Economy. An over 10% fall in US S&P 500 from April 2nd, when reciprocal tariffs were announced, to April 5th didn't seem to move President Trump. But the sharp rise in bond yields from around April 3rd to April 7th seems to have unnerved the president and forced him to put a pause on reciprocal tariffs. What's scary about the US bond yield spike? It has still not gone down. And what is it telling us? And what about India, of course, with its surprising fall in inflation numbers yesterday? For these and more, I'm joined by an absolute expert of fixed income markets, Sameer Goel, Global Head of Emerging Markets and APAC Research at Deutsche Bank. Sameer, good morning. Thank you very much for joining us. It's tempting for me to start with the ultra-low India inflation, but actually the world wants to know just what's happening. There are some bodies tumbling out on the US bond markets, people telling us this one went under and that one went under. But can you just tell us why the yield spiked? Normally yields should fall when equity markets fall.
True. I think what is happening at its very core, Lata, if you ask me, is that the US has enjoyed an exorbitant privilege of being able to fund its twin deficits without any major discomfort. And that's the advantage which it gets being the reserve asset of the world. I think what we have seen over the last few days, both in terms of the uncertainty which has been caused by the direction of economic policy, maybe the way of the execution, the credibility of policy, I think has ultimately damaged that exorbitant privilege. Now, to what extent, only time will tell, but I think that is what is putting US assets at the core of this confidence crisis the market is currently going through. And that, I think, very largely explains this breakdown, as you said, in correlation, where you're seeing all US assets fall concurrently. So you've seen, bonds sell off, you're seeing equities sell off, you're seeing credit sell off. And very importantly, in these typical times, you'd see a dollar smile where dollar as a safe haven asset would rally. But even the dollar is selling off. And like I said, I think ultimately at the core of it is an erosion of some of that confidence happening in US assets.
Okay, but even now, if India has to pay for Chinese imports, we have to use the dollar. Whether we have to buy European imports or crude oil from Middle East, we have to pay for it with dollars. So is this only a temporary discomfort that we don't know? The uncertainty in the US is high, so I demand a higher yield for now. Is this just a short-term blip?
Yeah, so I think, look, there are two ways to think about it, and also two narratives which the market is moving with. One, is this simply a recalibration to what is potentially a stagflationary shock, spike in policy uncertainty, making for a fairly difficult outlook for the Fed as well in terms of what it wants to secure growth and employment, or work against the possibility of a big sticker shock on prices? Is that all recalibrating US assets, US dollar weaker, or is there something a little bit more structurally broken here in terms of the confidence in the dollar as a reserve asset? Now, I'm inclined to more still favor the former. This is a price adjustment which is happening. The starting point on a lot of US assets was expensive. We are repricing that. We are recalibrating that. How long this persists will obviously depend upon, the speed with which we see normalization in this tariff policy from the US, and not just the tariff policy, but also the mix of overall economic policy which comes out of the US. Remember, we still don't know much about what kind of a tax policy, what kind of a budget will really come out of the US. But I think a sum total of that will determine whether we are just, like you said, is this temporary? Is this an adjustment? Or is this something which is a little bit more structural and persistent?
Okay. Well, I'm just relying on the fact that even when the gold backing was removed in 1971 with the end of the Bretton Woods system, dollar continued to hold sway after a wobble for a year or so. So I'm somehow not able to accept that de-dollarization is there. But anyway, let me come to the dollar itself. Would you bet on the dollar continuing to remain soft? Because that is the ultimate goal of the tariffs, right? To reduce the deficit by devaluing dollar. So can we bet that dollar is going to have soft days?
like to differ a little bit there. I don't think the objective of the tariff policy is to necessarily devalue the dollar. I think the dollar weakness is a result of not just the size and quantum of the tariff policy as it was put, which has obviously been a big shock to the rest of the world, but also the way it has been executed, and therefore, like I said, what it has done with respect to the damaging the credibility of policy making in the US. I think the dollar weakness is an outcome of that rather than necessarily the objective of the policy. The objective of the policy is to rebalance trade. The objective of the policy is to secure national security in terms of certain critical high-value capital goods, for example, which US wants to secure its supply chains on. And you can argue that the objective of the policy is also to be able to secure enough revenues, which can then feed back into the budget in the form of more tax cuts and greater spending and so forth. But yes, for now, weak dollar is, and I'd argue for now the path of least resistance is for the dollar to continue to weaken till we see some material shift back or reversal in the tariff policy.
Okay. So if the tariff policy is materially withdrawn, then the dollar strengthens. Otherwise, it continues to weaken, is what you're saying.
Yeah, because I think, and even there, I think you have to consider whether there has been a certain permanent damage, or not permanent damage, but there is a level damage which, if you might, has been done. Because even with where we stand right now, and unless, of course, you see a complete reversal of everything which has been talked about in the tariff policy, which I think is a relatively very low delta scenario, I think you will still see an economic damage, which has happened both because of the stagflationary shock to the economy, but also from the uncertainty on policy and the impact it has on investment and consumption spending. You can already see that in a lot of already soft data in the US in terms of sentiment, and increasingly seeping into hard data, though that obviously happens with a bit of a lag. VF, for example, our US team has already downgraded its growth forecast for the US for this year down to about 0.9%. At the start of this year, we were forecasting close to about 2.5%. Now we are down to 0.9. We were thinking at the start of the year that core PCE in the US will probably end the year on quarter 4 basis at about 2.5. Now we think it's probably going to be 3.6. So a classic stagflationary shock to the US economy, where growth is marked lower, inflation is marked higher. And I think that damage to some extent and what it means for US assets is very much it.
Yeah, actually, Goldman Sachs has also downgraded a lot of Asian countries, and I'm sure you guys also may have. Vietnam has been downgraded by 1.2 percentage points in terms of GDP growth. South Korea by 0.5%, Taiwan by 1%. So, the US shock translates into Asian shocks as well because of the tariffs. But Samir, let me come to the context of Asian currencies. Should Asian currencies worry? Usually when there is a tension, there is always this safe haven flight, and Asian central banks, EM central banks are worried. But this time around, that's one less worry?
So look, I mean, Asia has a little bit of a mixed outlook here as far as currencies are concerned. Now, on the one hand, the starting point for Asia is already one where there were, in many economies in the region, output already growing below potential. Inflation was undershooting targets. I think the very clear impact of tariffs, now whether it is a direct hit of tariffs on Asian economies or because of the indirect hit, because this time around the tariff policy is also very clearly targeting the connector economies, i.e. the circuit route from China to export to the rest of the world, and particularly to the US markets, right? And all of that would mean your negative output gaps will widen out, your growth will get hit at different levels, different proportions, depending upon how exposed you are to this US-China trade route, how exposed you are to global trade in general. So I think from that perspective, it's almost definitely more negative for Asia than it is potentially for a lot of the rest of the world. But on the other hand, like I said, this time, to the extent that the core of a lot of these issues are to also do with the US economy and a bigger shock which is felt to the US in some ways compared with the rest of the world, also now makes for a complicated thing where the dollar is weakening. So what happens as a net to Asian FX, I guess, becomes a little bit more clouded. I mean, the way I would think about Asia right now is that Asian currencies should underperform the rest of the world, and particularly currencies like euro, the safe haven currencies, euro or yen or Swiss franc. I think versus the dollar, I feel gets a little bit more dependent upon how far the dollar debasement continues itself, rather than necessarily on what happens in Asia.
Okay, two quick questions on India. First on the rupee, because we are on that topic. We were just flashing the renminbi. It's at 7.33 almost. So clearly China, even with its fixing, indicated that it will devalue the currency a bit. So what's your rupee range?
So, I mean, just one thing to clarify, I don't actually think it's in China's interests to devalue the currency. So just to make that clear. But on India, I would make the same point on the rupee. Like, India very clearly is in a relatively more advantageous position compared with the rest of the region, both in terms of its exposure to global trade, very specifically its exposure to the China-US trade, and obviously seems to have done much better already ahead of tariffs in terms of these trade negotiations with the US. So I think the relative economic impact is fairly minimal in India, or at least a lot lesser compared with a lot of the rest of the region. Like I said, again, for the rupee, the long-term or the real effective exchange rate has also normalized back to levels which the RBI should be comfortable with. So I think the sum total of that makes me feel INR is more of a beta to the dollar really here. Will INR outperform other major emerging market high yielders or the safe havens like euro or yen? I don't think so, but it probably will do relatively well compared with the rest of Asia.
Oh, okay. Got it. Final question for want of time. What about Indian rates? We saw this ultra-low March CPI number coming in at 3.34. The April CPI is expected to come at 3.1. At any rate, lower than March CPI. So are you seeing more rate cuts, maybe a double cut from the Reserve Bank? What's the end repo rate looking like?
I think so. Look, I think more than anything else, this inflation number tells you that we are sinking in well to the long-term inflation target in India, which is 4%. RBI needs to recalibrate its policy to now having achieved its long-term target, and which I would argue should at least mean repo rate at 5.5%. I'm personally biased to think that at a time when there is a prospect of negative output gap widening in even more because of this economic shock being felt in from the rest of the world, that we should potentially be able to see rates go down even further than that. At the moment, our base call is 5.5%, but the risks, I would argue, is that we see an even deeper trough to the rate cycle.
Okay, at least some gains there. If you're not making money on equities, you can make money on bonds if you're already holding them. Unfortunately, out of time, Samir, but enjoyed this conversation. Most educational. Thank you very much indeed for joining us. Well, wrap up on Bazaar on that note. Markets are just picking up, equity markets. That is, Chartbusters will take the action forward after the break.